Hello, welcome back. So in today's video, I'll be talking about why Google's sentiment is shifting and why the stock could be going back up to all-time highs again. So in today's video, I'll be covering a few things. We'll be covering Google's sentiment shift, diversification, some of my watch list stocks, and some questions that you guys have left me in the comment section below. So Google's stock here is up around 4% in the past month. From the low that it had this month, it's up around 11%. The stock is currently trading at 19 times earnings as compared to the S&P 500, which is trading at around 26 to 27 times earnings. So the stock is still relatively cheap compared to the market, and it is much higher quality than the general market itself. So for Google, it currently has the greatest AI suite. So it has the best coding model, it has the best video generative model, as well as the ads in your LLM queries as well. So for Google, this is their Veo 3. They are integrating this into Google Cloud and charging around $249 a month. It's quite incredible. Let's take a look at this video over here. This is Veo 3.
The time has come to tell you the truth. Artificial intelligence is here, and we can't stop it.
We have no idea how it works and what it is. It's alien, and it has been here for a while.
It built the pyramids, gave us technology and flight. Everything around you is a simulation. You have been prompted, like me. The difference is, you have more time than me. I just have 8 seconds. Sorry, I know it's sad to hear, but everything is written for you.
It's quite incredible, the video generative model that they had just now. And another portion that no one is talking about is your Gemini deep research. So if you didn't know, Gemini has this deep research portion where you can just ask them to write you a report. So over here, I asked Google to analyze the risk for the stock, and this is what they came up with. You guys should go and try it out. It's quite decent, and it's a lot better than Grok as well as ChatGPT. So for Gemini, they're integrating the entire Google ecosystem as well. So if you didn't know, Gemini is sort of like an AI agent right now. You can get them to do some specific task and to get up information from your email itself, as well as all your different other portions, including your Google Drive, your Google Docs, as well as your Gmail. So Google is creating an AI agent and an ecosystem leveraging on what they already have. This is sort of like the bundling mode that Microsoft has as well. So if you didn't know, what Microsoft does best is they will add on new things and bundle everything together and sell it as an entire package. And that is their moat. That is their moat because no one can switch out their products because they offer the best suite of products. The same for Adobe. So Google is trying to do something similar to that. They're trying to bundle everything together, create an ecosystem so that people can't get out of it. People will just end up using it. So Google is also introducing AI mode ads as well as your AI overview ads. So Google is starting to test even more ads inside its new AI mode search, rolling out sponsored product listings and recommendation directly in the AI-powered results. Ads are also expanding in AI overviews on desktop with mobile-like placements. US rollouts is underway. So Google is successfully integrating AI into search. Google is actively trying to push this out to its consumers. And if Google can successfully integrate the ads into its chatbot search, which is the AI mode as well as its AI overviews, I think it will be extremely profitable for the business itself. So if you were to compare this to ChatGPT, ChatGPT doesn't have a clear goal towards putting ads in its chatbot. Currently now, the main model for ChatGPT is simply just subscription. So Google, on top of the subscription that they have for their Gemini as well as their Veo 3, they also have this portion where they're rolling out ads as well. So if Google is successful with this, then this could be extremely lucrative for the business in the long term as well. And that's why I still remain bullish on Google. So over here, these are some of the headwinds for Google. So if search is going to disappear, Google has to innovate to stay in the game. This is sort of like a problem for the business because if the business needs to continually innovate, then there is risk with holding the stock. The company is also becoming capital intensive from being capital light. So Google from a few years ago is different from Google today. Google today is spending a lot of money into CapEx, bumping up R&D as well to try and create the best LLMs out there and to try and improve their cloud platform as well. So Google is currently now a capital intensive business, and typically for your companies that you want to hold, the minimal risk ones are the ones that are capital light. And then depreciation will also kill earnings if the returns don't come. So Google is investing a lot into CapEx, and if the CapEx don't yield returns, if the ROIC metric starts to come down, then that is when you will see that earnings get hurt as well in the future because the depreciation will come in the next few years or so, whereas your cash flow statements now are getting hit because of the immediate capex. So for Google's valuation, this is a conservative estimate, assuming a 13% EPS growth for this company. This company has historically been able to increase the EPS at a much faster rate, and assuming a 20 times earnings for this company, so basically holding its multiple today, This company will give you around a 14 to 15% CAGR, so it's on conservative estimates and you're already getting a 15% CAGR, which is typically market beating already and quite incredible performance. And let's say if the EPS growth goes to around 15% and if it re-rates back to market average, which is around a 26 times earnings, this stock will give you a 22% CAGR. This is even without factoring the fact that Google could become the next AI company that leads this AI race. And if it re-rates to an AI company, then you will likely see a lot more returns than just 22%. So for Google, this is the summary. The numbers are great. It's a high risk, high reward play. I own a large position in Google. I'm not certain about how search will look like in the next few years, and that's the risk with this stock because you have your LLMs which are growing exponentially, and it has been over the past few years. The competition is intense and competition leads to losers and losers lead to profit loss. So for Google, it has never experienced any form of competition in search before, and currently now it's facing competition in terms of its search. And if there's more competition coming in, if you see more LLMs coming in from China as well, then that could start eroding the search platform. And that is probably the worst case for Google. So for Google, it's facing competition now. It needs to defend its moat. But typically for companies, you don't want them to have a need to defend its moat. You want them to expand their moat. And currently, Google is in a state of defending its moat instead of expanding it. So Google, numbers look great. I'm bullish on this company. But over the long term, the risk could become a lot more obvious than it is today. Next portion over here, I'll be talking about diversification. So diversification to a small extent is great. Concentration to a large extent is great as well. This is normally the approach that you want to take. You want to diversify so you don't get killed by one mistake, and you want to concentrate so that you buy the highest quality businesses out there. So this is Li Lu's portfolio over here. He's sort of like the China Warren Buffett, and as you can see from his portfolio itself, he is extremely concentrated. So he has around 26% of his portfolio in Bank of America, 21% in Berkshire, a combined 34% in Google, and then there's another company as well, which is East West Bangkok. I'm not sure what they do. They have Oxy, Sable Offshore Corp, as well as Apple. So Li Lu over here is a highly concentrated portfolio manager. He has his highest stake, which is Google, at around 34%, which is quite remarkable. So this is what Li Lu had to say about diversification.
Thank you for coming today. I wanted to ask you a question about portfolio construction and just hear your comments on diversification. In the last session, there was a lot of discussion about diversification and the importance of it. My sense is that you're more of a concentrated investor. Some other investors are like that. Where does that, what kind of role does diversification play, or how do you think of it in building a portfolio?
Well, you always have to have some kind of a diversification. Because A, you could be wrong, and B, even if you're right, you're betting on statistics. In other words, the future is essentially a distribution of all probabilities. Say you have a 90% conviction, and you're right, that event is 90%, but then 10% chance it happened. And so you don't want to that 10% to get you out of the game. So you do need to diversification. On the other hand, that recognizing is extremely rare to find no-brainer great opportunities. Extremely rare. In fact, you have to wait for a long time before the fat fish to come to you. So when that happens, you certainly do not want to diversify away the opportunity that you have been waiting patiently for a long time to discover for some really inferior other opportunities. The investment is essentially the opportunity cost. So one other alternative have to really justify itself by comparing with the one you already have. And so when you make that comparison, you tend not to really diversify too much. You would find a few very, very good ones that have a very high conviction and let it rise. And so yes, you do a little bit of both.
So in that example, and you're kind of hitting precisely what I was getting at, in a very high conviction idea, what do you feel the limits are in terms of how much you could be invested?
Well, I would say, as I said, that all decisions ought to be looked at through the concept of opportunity cost. Is what else can I do with the cash I have? And cash, by the way, is really a fundamentally important asset. And if I don't really find anything else, or if I find a bunch of other opportunity inferior to cash, then I would keep it in cash. And so I would say that that it never bothers me to hold a large amount of cash when I can't find great opportunities. At the same time, when I find, say, one good idea, I'll let it be a little bit bigger percentage of the portfolio, and then everything else will compare with what I already have, which is cash. And sometimes holding cash can be the result of a bottom-up research. I always believe that's the case.
Yep, so that's what Lilu has said about diversification. Next portion over here, I'll be talking about some of my watch list stocks. So over here, there's a comment that says, "Hello, thank you for answering my question. What are some undervalued stocks you are interested in? Thank you." So there are three main undervalued stocks that I'm looking at right now. The first one is Alibaba. Alibaba is incredible in China. The moat is almost impenetrable. And if you're buying into Alibaba today, you're basically betting on the fact that the Chinese consumer in China will recover. So for Alibaba, the tailwinds for this business are quite remarkable right now. You have your consumer that is recovering, and then you have your AI story in China that is growing as well. So Alibaba in the latest quarter had around 18% growth in their AI segment, which is their AI cloud segment. That's remarkable for a Chinese company. And currently now it has the greatest market share in your cloud computing space in China. And with a lot more growth ahead in your cloud computing space in China, simply because of greater digitalization, greater usage of cloud processors, then you will see a lot more growth for Alibaba in that segment. But that segment is not the cash cow for the business right now. The main cash cow for the business is the retail portion. So if I'm buying into Alibaba, I'll need to bet on the fact that the retail will recover. So if you're to look at the consumer confidence in China itself, the consumer confidence has been down by quite a fair bit over the past few years, especially because of the deflation and the weak economic sentiment, as well as the housing crash in China. So for China itself, I think the government is trying to continually push stimulus checks to try and improve the economy and improve the spending. And if that happens, then Alibaba will be a great beneficiary of it. So Alibaba is a company that is quite high quality in China itself, trading at a decent valuation. And I would like for it to have more of a discount before I enter into the position, around $100 to $110 a share. That is where I'll initiate maybe a 1-2% position in Alibaba today. Next stock is LVMH. So LVMH is Louis Vuitton. This company is just impenetrable. It's a white moat company with many different brands under it. So it's sort of like a Berkshire in luxury. The problem with the business today is I don't really see a catalyst with the stock. So there isn't much of a growth in the business right now, simply because the Chinese portion is not recovering. The Chinese luxury portion is dying. The revenue in the Chinese segment has been declining for about 2 years already, and that is hurting LVMH. But for LVMH, I view it as a high quality luxury company that will stay here for the next 20-30 years or so, simply because the brand is so powerful. It's similar to Hermes, Ferrari, as well as LVMH. These three companies are the greatest luxury companies in the entire world, and so I don't feel uncomfortable holding LVMH through all these years. And if you get a right price point for LVMH, you can get a market beating return on that stock price itself. I'm looking at LVMH at around $90 a share. That is when I'll be adding into LVMH at around a 16 times earnings. A 16 times earnings for a company that is such high quality as LVMH is a very good opportunity. Hopefully it comes soon, but we have to wait for that one. Currently now it's trading at around $110 a share. Next one is your consumer staple stocks. So your consumer staple stocks, a lot of them have been beaten down recently simply because the yields have been going up. So when your yields go up, people tend to rotate to bonds instead of buying stocks, because bonds have zero risk. You can just buy the T-bills itself and collect back your capital for free. But for the stock itself, there is risk of the company going down in stock price. So for all your different staple stocks, I have yet to find a company that is high quality enough to meet all the different metrics that I have. Currently now, I think the closest one is probably Pepsi, simply because of the brand itself and the suite of products that they have. But the valuation is not cheap enough. It's trading at around a 19 times earnings. I would like for it to go down to around a 15 to 16 times earnings at around a 6% yield. That is when I'll be comfortable adding into Pepsi. I've looked into Kraft Heinz as well as General Mills already. General Mills has a decent suite of products, but the problem is the Häagen-Dazs portion, which was the one that put me to the stock in the first place, is licensed to Nestle until 2110, the year 2110. So they basically get no sales, they basically get no revenue from that Häagen-Dazs portion in the US itself. So for General Mills, currently it's a stock that is trading at a relatively cheap valuation that will give you around a 7 to 8% returns every single year. So that one's on my watch list. And then the other one is Kraft Heinz, but the problem with Kraft Heinz is the suite of products is simply not good enough. The only thing that I know from Kraft Heinz itself is the tomato sauce that they sell. And other than that, I don't see much brand loyalty there, as well as brand strength. So currently now, the staple that I'm looking at is Pepsi, as well as General Mills, General Mills is lower quality than Pepsi but trading at a relatively lower valuation as well. If Coke can go to a 20 times earnings, that will be when I'll be pouring my money into Coke. Coke is the best consumer staple out of all these different stocks over here. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one, it says, thanks very much for your sharing. May we invite you to share about SMCI? A lot of analysts said it will rise, but it doesn't seem so. When will it hit $60 USD? So personally for me, my belief is that no one can predict a stock price. I mean, you can make bets here and there and play the probability, but it's all a probability game. It's not so much a prediction game. So I don't know when the stock price will hit $60. And for SMCI, I think the company is facing a lot of headwinds. It's facing slowing demand. And if you were to look at the latest earnings quarter itself, they had a lot of downward revision, which could signal a weakening AI hardware demand as well. So for SMCI, I don't know much about the company. I mean, the company had an accounting fraud case last year which put down the stock price. And so I think in the AI space itself, the best company to simply just put your money into is ASML or TSMC. TSMC is lower quality than ASML because TSMC is situated in Taiwan, China, and that is what I'm uncomfortable with. The company is in the midst of sort of like national security issues and all that for TSMC. As for SMCI, I don't know where the stock will hit $60. I can't predict the stock price, but hopefully it goes well for you. Hopefully you got the returns that you want to from this stock. Next one, what do you think about SATS? So SATS, if you didn't know, it's sort of like a logistic business in Singapore. They package food and then they do cargo shipments and all that. So for SATS, if you're to look into their balance sheet itself, I think the balance sheet is unsustainable. So if you didn't know, a few years ago, they did an acquisition and they bought another company at sky-high interest rates. And now they're servicing that debt. The problem with the stock itself is if you're to look at the debt to EBITDA, for example, the debt to EBITDA is around an 11 times, meaning to say they need 11 years to pay back that debt, which is quite insane. So for the company, I think the only problem with it that I'm seeing right now is simply just the debt. The debt has been steering me away from this stock. It is a decent company, don't get me wrong, in Singapore. They have quite a diversification outside of just Asia Pacific. They have their Middle East portion as well as the US portion where they make money from those segments. But SATS is a business that simply has too much leverage, and that's why I'm not actively investing into this one. I don't think I ever will until they clear off all that debt that they had from the last few years as well. Last comment over here, it says, I feel that as an emotionally mature and intelligent investor, he or she should always do his or her due diligence and never follow anyone blindly. It's very difficult to follow someone else's method blindly. Everyone has different financial situation, risk appetite, investment horizon. Not talking about Quan Ray here, but I often see comments on other platforms blaming some random YouTuber for their investment decision. And I feel that as a fellow investor, I'm 100% responsible for my own decision. So yes, I completely agree with you over here. As an investor yourself, you should always be doing your own due diligence. Don't just randomly follow a YouTuber into a stock, like what I did back in the day when I was buying Tesla because of a Singaporean YouTuber. So always do your due diligence, always have the conviction when you're holding the stock, because if you don't have the conviction to hold the stock, then when the stock falls, if the YouTuber doesn't sell, if the YouTuber doesn't tell you to sell, you might just end up selling the stock anyway. So have your conviction, build up your own thesis, and buy the stock only if you know it. Thank you so much for watching. I hope you guys have found this one useful, and invest safe.